Hello everyone, my name is Maria Thomas and I work for Allianz Research, a global team of economists, strategists, sector advisors and foresight experts of the Allianz Group, led by Ludovic Subin. Over the past few months, we've seen central banks in advanced economies raise interest rates for the first time in years to cope with record-breaking inflation. So in this special season of Tomorrow, we wanted to look at the end of zeronomics. What will the new era of higher interest rates mean for the global economy and capital markets, households and companies? Let's find out with the experts from Allianz Research. Rising interest rates are a big shock for companies, but some sectors are more exposed than others. In this episode, we speak with Ana Boata, Head of Economic Research at Allianz Trade, and Ano Kuhanathan, Head of Corporate Research, to find out what the end of zeronomics means for companies. Hello, Ana and Anu. Welcome back to the podcast.
Hello, Maria.
Hi, Maria.
So to start, can you explain for our listeners what did the era of low interest rates mean for companies?
Yeah, well, it's true that we have been almost a decade in an environment of low interest rates and also high liquidity. Let's not forget also the very strong quantitative easing programs, which of course allowed the area of easy money and more corporate debt. So clearly, I think over the past decade, what we have seen, and also with the crisis episodes, is that corporates have indebted themselves to record high levels. They have been reached also in the start of this year. But I would say that, well, while this record high debt is obviously not a very positive trend, especially in the future with the increase in interest rates, it's not also bad because, of course, there have been some structural changes in the composition of this debt. Of course, 75% of corporate financing is still bank driven. But I think if we look at the liquidity positions over the past years, there has been a clear, strong improvement. And this brings me back to the notion of net debt, which is also very important, and clearly which went down to levels that we have been seeing at the beginnings of the 2000s. So that's clearly one, I would say, element of resilience at the start of this hiking interest rate cycle. And along with that, of course, is every agent, when you can, you increase your average maturity and you change your vulnerability structure. And this is what European corporates have been doing as well, because actually more than half of the corporate debt has increased its average maturity, and it's now above 5 years, which again increases the resilience against the wall of redemptions in the very short run when volatility is there and maybe there can be some scarcity and of course higher interest rates. So that's clearly something that is positive because corporates have a lower short-term borrowing dependence, I would say, thanks to this long period of low interest rates and easy money. Now, of course, as every company structure, interest rates and financing costs are part of their expenses structure, along with labor, along with input costs, and clearly having low interest rates until now has been a source of profitability. Obviously, it's reversed now with the ongoing, even if moderate, increase in interest rates, and it will and might become, of course, a problem for some of the sectors that are more indebted in the coming months and quarters.
So maybe let's go into that a little bit more in detail. What exactly do you expect to happen now that interest rates are on the rise?
So from a corporate perspective, Maria, we need to, first to keep in mind that about 2/3 of corporate debt in Europe is in variable rate. It's also about 3/4 of corporate debt in the US. So it's definitely pushing interest rate expense higher for many corporates. And at the same time, because of the inflationary backdrop that we have today, actually, for many corporates, working capital requirements are increasing. because of supply chain bottlenecks and inflation. Companies have been piling up on inventories. And what we are observing is that working capital requirements have increased by 6 days of turnovers in the US over the first semester and by 10 days in Western Europe. So all of this is pressuring firms to remain highly leveraged. And in most sectors, we are seeing increase either in short-term debt for companies who are very pressured by increase in working capital requirements. And we are also seeing some other sectors where there is some increase in longer term debt. But overall, most sectors are showcasing an increase in indebtedness.
So, which sectors are you most concerned about?
So I think what is also very new in the current context is that we are finally seeing some heterogeneity in terms of risk among sectors and regions. So we talked about interest rate, and among the sectors that are the most leveraged, we can name a few: construction, airlines, machinery and equipment, or transportation. And that's pretty much valid on both sides of the Atlantic. But now we're also seeing some risks which are very specific to regions. And obviously in Europe, one of the main issue is the energy crisis that is ongoing. And that has been particularly hitting some sectors, the energy intensive ones. So to name a few, we can mention the paper sector, metals, chemicals, obviously the power sector, but also telecoms. So these are the ones that are going to be most under pressure in Europe. And on the other side of the Atlantic, we also have some specific issues. So right now, the dollar is quite strong, and that's impacting all the sectors that are traditionally relying a lot on exports from the US. So again, to name a few ones, we can mention electronics, machinery and equipment, household equipments, or computer and telecom in the US, which are definitely going to lose some competitivity on external markets due to the strong dollar.
Okay, and how long do you expect these rising interest rates to last?
Yeah, that's the key question nowadays, I would say, because we all see we are a bit at the crossroads when it comes to the hiking cycles. There are countries that are suggesting they are approaching the end of the hiking cycle, and out of a sudden they are victims of market attacks. If we take the case of Hungary very recently, but also the UK, of course, the most obvious one, where clearly the fact that the fiscal stance is going against the monetary one creates even more trouble for the central bank. And I would say in general, as Anna was mentioning, the fact that we have a strong dollar brings back the idea of having longer hiking cycles to control also the amount of imported inflation and therefore the developments of the currency. So while we forecast a pivot in 2023 in rates, which means that probably at the mid of the year we would have, because of the recession, ongoing recession, a fall in interest rates, a moderate one. We might actually have this fall from higher levels at the end of this year, early 2023. We clearly see over the past weeks, inflation rates are still surprising on the upside, be it in the US, but also in Europe. Of course, not for the same reasons, much more demand driven in the US, and clearly supply driven and energy crisis driven in the Eurozone. But the result is a bit the same. Aggressive central banks that remain very determined to fight inflation through the classical tools, and those that are hurting much less the market liquidity, right? So interest rates. So I think indeed that we are going to see probably a peak in interest rates in the US beyond 4%, so probably closer to 5%, if inflation continues to surprise on the upside. Above 2%. Somewhere above 2, maybe even closer to 2.5 in the Eurozone. And then, of course, in the emerging markets, still continuation in the tightening of monetary policy and increasing in interest rates for those countries that are most vulnerable to capital outflows because of their weak fundamentals, right? And we have some in Europe, we have some in Latin America, some in Africa. So we are not yet at the end of the hiking cycle, even if, again, market conditions, growing financial risks are clearly asking the question for how long this can continue. And we might the pivot can be more into the favor of market liquidity. So, for example, liquidity operations, comeback of quantitative easing programs, at the same time of increasing interest rates in the short run. So we should be, as a company, be prepared to see higher bank loan interest rates, especially because the mark-to-market is a bit slow currently, probably also because of the amount of liquidity still in the market. But we do see that bank loans rates have increased by more than 100 basis points in Europe since the beginning of the year. So it will continue in our view into 2023. And clearly that is something that, as Ana was explaining, will increase further interest expenses for corporates. So clearly the peak should rather be, in our view, after mid of next year, because of the lagged transmission from key interest rates to bank loan interest rates.
All right. Well, thank you very much, Ana and Ano.
Thank you, Maria.
Thank you, Maria.
Thank you so much for listening. You can find the full report we just spoke about on our website. We'll leave a link in the show notes. If you'd like to discover more of our research, you can also follow the Ludonomics newsletter on LinkedIn. We'll leave a link down below for that too. If you like the podcast, please send it to any of your friends who might like it too, and leave us a rating and a review. We'd love to hear your feedback. In the meantime, stay tuned for the next episode.